Hey, what's up everybody? It's your mortgage expert, Brian McCauley. So are you looking to buy a house in Dallas, Texas, but you're concerned about the state of the market? More importantly, want to know where interest rates are headed in the future? Stick around. This video is for you. So we all know the housing market is starting to cool off and correct. I think that's a great thing. As things cool off and there's not so much madness and multiple offers, what it's doing, it's leveling the playing field. Now, what we have to do is we have to see the good and we have to see the bad, right? So the bad is there's still not enough inventory. There's still multiple offers out there. But the most important thing we got to pay attention to right now are the interest rates. People don't seem to care as much about what they pay for the house as they care as much about their monthly payment. So the interest rates affect the monthly payment more than ever. So people are looking for different strategies on what to do about interest rates, what are different structures, where are they headed in the future. So I'm going to talk about a few of those things. Number one, I want to talk about interest rates, what you can do to get a lower interest rate. There are two options. The easiest option is to do what's called discount points. You can buy a lower interest rate than what you qualify for. It may cost $2,000, $3,000, $4,000, $5,000, but it could save you $100 or $200 a month. So you may be doing some upfront money to buy down the interest rate. But obviously, if you save money in the monthly payment and you stay in the house for long enough, you'll break even, get that money back, and start making money on that money. Number two is doing an adjustable rate mortgage. So adjustable rate mortgages are actually really good programs for people that know that they're going to be in a property for a short amount of time. Those adjustable rate mortgages are based on 30-year payment schedules. They're just not fixed for 30 years. They're fixed for a shorter period of time, 5 or 7 years. Those interest rates can improve from a 30-year fixed up to 0.5%. So if you think you're going to be in a house for a short period of time, you can take an adjustable rate and that will help you save minimum a quarter on the rate, sometimes 3/8, sometimes a half, sometimes even more if there's investors out there running specials. So the third thing I want to talk about is the future of interest rates. So no one has a crystal ball, no one knows. I'm going to tell you this isn't advice, this is just my opinion of where I think things are headed. I think the rest of 2022, interest rates for everybody's probably going to hang around, again, depending upon FICO score, down payment, all that fun stuff, but anywhere from probably the mid to high fives to the mid sixes. We may see them go mid sixes, high sixes, depending upon inflation in the backside of the year, but rates are going to continue to stay up. Now, a couple things I want you to have perspective on. Number one, historically, interest rates in the fives are still very, very low. We all know back in the day before I was born, before I originated, and I've been doing this for 17 years, interest rates used to be in the double digits and people were just happy to get a home. So things I want you guys to keep in mind is perspective, that even if you get an interest rate at 5.99 right now, overall it's still a really good competitive rate. It's just the fact that rates went up from 2.99 from Christmas until now, there was too fast of a jump. It's a concern. So again, I think rates are probably going to stay in the high fives, the low sixes through the end of the year. I don't know what 2023 has in store. Let me give you my projection, but again, only my projection. I think rates will stay around the 6% range. They might get as high as 6.5%. They might get as high as 7% in the next 6 to 12 months. I don't know that for a fact. There are so many variables out there with inflation, with the economy, with the potential recession, that we just have to see where things go. The good news is if you are in Texas or specifically in Dallas, you're in a wonderful place from an economic standpoint. There are just so many people and businesses coming here that the economy is so strong. My opinion is, even if there is a recession, whatever the recession brings, we're going to be able to absorb it a lot better than the majority of other states and cities. So on a scale of 1 to 10, if the average recession felt is a 6, I think Dallas, I think Texas probably going to be a 2 or 3. I think interest rates after 2022 will probably stay in that 6% range, at least probably for Q1, maybe Q2 of 2023. Again, I don't know that for a fact, but if I had to bet on it, I would. I think the midterm elections have a lot to do with the way things are going to transition in 23 and 24. The biggest component, guys, is really the inflation piece. They have to get that down. Consumer spending is still way, way up. I know even myself and my family, we're still going out to eat. We're still traveling. We don't love the cost of everything, but at the same time, given the COVID lockdown for almost 24 months, human beings just aren't ready to give up and stop spending yet. Inflation is supposed to, curb that, right? Because things are getting more expensive, but it hasn't slowed down a ton. So I think you're going to continue to see some more inflation. Here's the light at the end of the tunnel, okay? Always, real estate market and mortgage markets are cyclical. Normally, it's about a 7-year cycle. We've had about a decade good run. So a couple things I want you to remember about interest rates, okay? Number one, if you have to take a higher interest rate right now, you're not going to keep that interest rate forever. I promise you, I've never met a client that bought a house, closed on an interest rate, they're still in that house, still with that rate, still with that home loan, and they haven't changed anything. So even if you have to take a higher rate, look at it as a temporary rate. What I mean by that is there is going to be a refinance boom. Interest rates will most likely come down. Let me tell you why. So what happens is when you have so much inflation and interest rates continue to rise, what happens is when rates continue to rise and it costs the consumer too much money, they stop spending money. That's what the government wants. They want things to slow down so they can get this inflation under control. The problem with that is that once it slows down too much, there's no GDP, gross domestic product, and gross domestic growth. Now, the United States needs that because we need our economy to grow and we need our economy to boom. Why? Well, our economy needs to grow so investors have places that they can put their money. They can put it in the stock market, they can put it in businesses, right? Because if they don't have anywhere to put their money, what are they going to do with it? They're going to put it overseas where they can grow it over there. And obviously our economy doesn't want that. So as inflation eventually gets under control with rising interest rates, it will slow things down. As it slows things down through our GDP, it will probably come to too much of a halt. And then once it comes to too much of a halt and the economy is no longer growing, it starts to do one thing: recede, aka a recession. So once it starts to recede too much and they need to stimulate the economy and stimulate activity, most of the time they do two things to stimulate activity. Number one is they change the tax laws. So they'll lower the tax laws on businesses, they'll lower the tax laws on people to incentivize businesses specifically to get out there and spend money. The second thing they will do, and this is where you need to pay the most attention, is they will cut interest rates. If the government wants people to go spend money and get out there and shop and refinance homes and buy cars, they'll bring interest rates down because cheap money incentivizes me and you to go out and spend. So I say all that to say, hey, understand it's only a temporary thing until they get this under control. And then once they change the tax law and once they cut interest rates, one of the biggest things people will start doing is they will refinance their properties. So if interest rates drop back down in 24, 1% or 2% lower than what they currently are right now, every homeowner is going to refinance to improve their financial position. If they say, hey, I've got a 5.5% interest rates and now the market's back down to 4.25%, 4%, 3.99, I can save myself $200, $300, $400 a month. Everyone is going to refinance. So I say that because if you're a buyer out there and you're concerned about current interest rates and you're concerned about the future of interest rates, don't wait for the rates to drop now. Don't wait for the prices to drop now. I would tell you to buy the house and date the rate. That's the biggest component about it because you're going to keep the house longer than you are the mortgage term. And as soon as the interest rates drop and you get a chance to refinance, lower your interest rate, improve your overall payment, you're going to do so. So don't let that discourage you. Hopefully that's been helpful for you, kind of where the market's at, where interest rates are at right now, where interest rates are headed in the future, and then when I think they'll come back down and how that'll benefit you. So listen, if you found this video about interest rates helpful, do me a favor, like, subscribe, share with somebody else that you know that could benefit from this. If you got a question, throw something in the comments below. We promise to get back to you. But if you just want to set up a consultation with me, talk about your current financial position, future housing needs, or just mortgage questions in general, call us, email us, text us. Just know that I'm always here to help. We appreciate the support. Until next time, stay tuned.